Hello and welcome all the Web3 enthusiasts. This is Max speaking, and this is a new exciting episode of Synopsis. Today I'm hosting with Karen Soroya, CEO and co-founder at Bree Protocol. Hi Karen, how are you today?
Hey Max, thanks for carving out some time to speak with me. I really appreciate it.
Yeah, always a pleasure to have cool guests like you, and hopefully today's discussion will be insightful and interesting for everyone. Let's just kick off because I have a bunch of questions for today, and the first one will be just to warm up and for you to introduce yourself for our audience since it's your first time here. Could you please go ahead and tell us about your journey in Web3 and the background in general?
Yeah, sure. Look, I've been in the wilderness for a long time. I've been building businesses for most of my professional career. Started as a management consultant, built a e-commerce marketplace called StyleKick that scaled to about 1 million actives. That team joined Shopify pretty early on. Loved the time there. Left to do Y Combinator about 8 years ago to eventually scale a national insurance company or national insurance entity called Cover. So I've been, largely web two businesses, consumer facing, some B2B elements. And then now work on which in my mind is like a step change, like a true step change in a really massive market. And the basic idea is if you believe that stablecoins are going to proliferate, if you believe that crypto economic assets find their way into the mainstream, especially the high quality ones, we want to be able to use those assets or enable people to pledge those assets as collateral to a global capital lake that supports any insurance market in the world and any insurance company in the world. And so, the beauty of what we're doing is we're a regulated business. What we're attempting to do is grow global insurance capacity. And this kind of harks back to how insurance and reinsurance initially operated, which was on a decentralized basis. It was peer-to-peer, with like-minded individuals pooling capital to self-insure. Then specialization happened over the following 300 years. Now we're living in a world where technology facilitates a completely transparent insurance capital layer. And I think it has the potential to impact tens of millions of businesses and hundreds of millions of people moving forward. So that's what we do. In the United States, to give you a sense of scale, in the United States, we reinsure 350,000 policies. Eventually, it'll be tens of millions. We back 26 insurance companies in the US. Eventually, we'll back insurance companies everywhere in the world. We do about 170 million in top line business and we're hoping to end this year between 400 and 450 million in business.
Wow, thanks for the great intro. And the next introductory question is actually about the project. About the naming, could you tell us what does RE stand for? Is it reinsurance, restaking, or maybe both, or maybe even something different?
Yeah, so there are kind of like two schools of thought on this, which is like one, it's an incredibly elegant name for what we
Yeah.
do, which is related to it's just related to reinsurance, but also, if you think about what crypto is and what most infrastructure plays are, especially the ones that kind of lead up to restaking, those are largely insurance protocols, right? And so like you have crypto economic assets that validators put together and to secure a blockchain that could be slashed. This is effectively insurance risk. So just kind of worked nicely that from a conceptual perspective, it is also like restaking. But the original idea was there are a huge number of large reinsurers, Munich Re, Swiss Re, Hanover Re. Um, there's probably a future here where if we can get to significant enough scale and connect crypto economic assets to the insurance market, we could be the Re. So that was the kind of the impetus behind Re.
Wow, awesome. So yeah, it's for a
Yeah,
reason for sure.
for sure. Yeah, it's also terrible for discovery purposes. Just two letters, and we have a two-letter domain and two-letter handle, but that's the other side of it. There's one side of it says it's an elegant name, the other side it says discoverability suffers. But right now, I'm very happy with elegant.
Yeah, I think that with the time going on, it will be easier and easier to discover. The bigger the project comes, all good in this way. And yeah, the next question would be coming out from what you said in the introduction, actually. So having returns that are uncorrelated with typical market volatility is an awesome thing for sure. And Bitcoin price was once uncorrelated with the broader financial market, but those times are long gone. So could you please tell us about the industries your reinsurance contracts come from?
Yeah. So, like in general, insurance and reinsurance tend to have like a beta of less than one. So they don't tend to follow the market directly. Um, and if you unpack it a little bit, like what we do is real world insurance, right? Like we quite literally will back tens of thousands of small businesses, hundreds of thousands of workers across workers' compensation. We'll do hospitality insurance for bars across America and like the Marriott's. And so, there's real economic activity. Hence, if there's any sort of cyclicality in the macro, actually, a decline in economic activity tends to result in better overall insurance economics because you have lesser frequency of claims and generally lesser severity of claims as well. And so, if you peel all of that back, right, what what the insurance claims and experience across, let's say, a book of 10 million small businesses across the world, how that performs with respect to the premiums you're collecting and the claims payout is not related to where Bitcoin's at. It's also not related to where the Nasdaq is at any given point in time, right? The other part of this business is like there's the more plain vanilla part that we do, which is traditional insurance lines, contracting with insurance companies in the way that they expect to be contracted with and doing business with them in that way. The other side of the market, there's a long history of pension funds, sovereign funds, and like large institutional players titrating into the catastrophic risk market. And so this is quite literally, putting up capital to provide insurance capacity to California homeowners against wildfires or earthquakes, or hurricane coverage in Florida, or earthquake coverage in any earthquake zone in the world. That in of itself, whether an earthquake hits or not, or whether a hurricane hits or not, what the severity of the damage looks like, and the resulting economics of that, completely uncorrelated with the broader overall market dynamics. And so, often what people will do is like, especially at that scale, is like you'll have like a 5% allocation to insurance as part of an overall portfolio, and that this kind of mutes or adds significantly to the diversification effect. So saying all of that, there aren't really market conditions that move remove the diversification element in the way that we've seen economic assets start to become correlated with traditional markets. Yeah.
Awesome, thank you. So, of course, in this podcast, we cannot but speak about the risks. And since you offer a high APY, everyone is looking for, it's of course associated with the high risks. Could you tell us what are those risks exactly that your users face, and how do you mitigate them?
Yeah, for sure. Look, I think the first and most important point is that our counterparties are regulated insurance companies. Our customers are insurance companies, right? And so if you look at kind of like the prior waves of DeFi, and this is not a complete analogous, but you had under collateralized lending. You have over collateralized lending, in Bitcoin, and there are associated like risk mitigation dynamics kind of that are in place. The core word there the common theme there is underwriting, right? And so like where what you would inevitably see with like new market entrants and like new sources of capital like this that don't necessarily have network access, they get adversely selected against, right? And so you're not getting the best deals potentially. And so some of the risk reward here, and we think of it as like a generally favorable risk reward return ratio, and to that end, like we effectively pledge all of our capital and balance sheet purely to insurance risk. So we really believe in what we're cooking at the end of the day. The risk you're compensated for is effectively insurance risk, right? And that is, of the blocks of risk that we take off of the balance sheets of insurance companies, tens of millions of dollars worth of auto, home, workers' compensation, et cetera, small business, commercial. At some point or another, our claims and related expenses are going to exceed premiums, and any sort of capital cushion that we post. Now, it's very possible for an individual insurance company to have an unprofitable program. The beauty of kind of insurance is that as a whole, it tends to be profitable. And so if you look at it on a portfolio basis, you end up with a very significantly protected surplus capital ratio. And so if you think about, insurers or reinsurers like Munich Re or Swiss Re, the only times that they've ever experienced significant impacts to their surplus, the in this case, the stable coins that are being deposited as collateral, has been with catastrophic risk specifically. And so if you're quite literally betting on, whether wildfires hit California or whether, an earthquake is going to hit California or multiple hurricanes hit Florida, you can make a very high margin betting affirmatively on that, or lose your capital, right? And so a good Sally's example of that, and if you guys are really interested in kind of understanding the history of this, is like take a look at Munich Re versus Swiss Re, right? Munich Re has been printing money in the traditional reinsurance business with some elements of catastrophic risk, whereas Swiss Re has not. So a big part of what we do is like pure low volatility, plain vanilla lines of business. The other thing that's incredibly important, it's not just insurance, it's all of DeFi, is there economic alignment between all the counterparties within this value chain, right? From the origination of the risk to the ultimate risk bearer. And so in insurance, like if you're writing insurance, like let's just say you wrote Synopsis Insurance Company in St. Petersburg, Russia, right? If you go out and you write $100 million worth of home insurance, in an efficient market, you need to believe that $100 million covers all your claims, related expenses, and delivers you a profit. Otherwise, there's no point for you to be in business, right? Now, the point of a reinsurer is to basically place a safety cushion over top of that 100 million in premium that's collected and act as a working capital layer. And so for us to be able to get comfortable to participate alongside your insurance company, you have to take risk. Any origination fees that you charge for originating the risk itself have to be at risk. The underwriters and actuaries that assess this business have to have economics at stake before the reinsurance capital layer will absorb a loss or will even become party to the insurance program, right? And so everyone wins or everyone loses is like the general thinking behind this. And it starts with the origination step all the way to the risk-bearing layer, right? And so in my mind, that's the only way that you can actually get these types of businesses to work, especially in kind of like a decentralized fashion. But also just in the, if you look at the historical context, in TradFi, this is how it works. And this is how typically economics are protected.
Wow, super detailed. Thank you. And with so much information, thanks for putting everything in order. All sounds reasonable. Yeah, and thanks for the great examples. For me, it's pretty easy to understand when talking in this format. Awesome. So moving on, and what about the defaults actually? So could you tell us how many defaults did your reinsurance contracts have, and what happens actually when a contract defaults?
Yeah, so we're not a lender, right? Like we don't send out money for people to consume. We're an insurer. And so our job is to show the world, like make promises to pay under certain conditions and then prove to the world that we can pay under those conditions, right? And so typically the cash flows work this way, right? Like in our model, we're a fully collateralized reinsurer. And so what we do is we take in capital, we post it to the benefit of the insurance company in a trust or segregated account that's bankruptcy remote. It's capital that's available to the insurance company should they need it. And the insurance company, when they go write the insurance, effectively funnels those premiums back into the trust account to work as a working capital layer to settle any claims. So to answer your question directly, we have had unprofitable insurance programs, but not ones where we've lost our shirts. And on a portfolio basis over the course of 3 years, we have been underwriting profitable, right? And so it is exceedingly rare to have a diversified portfolio of insurance risks that are geographically diversified and line of business diversified compromise capital. You can have individual deals that are not profitable, but it rarely, if ever, compromises the entire amount of capital that has been staked. Typically speaking, you don't see capital erosion. You see erosion of any sort of profit is typically what happens.
Awesome. So previously we had a very detailed question and answer, I mean, and still I would like to ask one more to make it absolutely clear, especially for me and for the part of our viewers. So could you please tell us how the reinsurance contracts are settled? Are they originally denominated in stable coins, or do they involve fiat on and off ramps?
Yeah, so this is kind of where things are getting exciting, right? Because like in the United States now, we have stablecoin legislation, and we're starting to see what the guardrails are for treating stablecoins like cash and cash equivalents, right? And so if you have fully collateralized stables, if they're readily redeemable, if they're being minted by U.S. banking institutions or other institutions that are credible, then and these entities are now able to custody these stables. Where we're headed is that all of this gets settled in stables, right? And at least the collateralization piece, to the benefit of the insurance company, the cash flows in and out of these trust accounts get settled in stables. Um, and ultimately the claims, will have to be off-ramp to fiat. But even then, you can kind of see a future where stablecoin proliferation makes it really easy just to send the policyholder, a stablecoin denominated, wire directly to their wallet as opposed to a check, that's passed through an adjudicator and like an accounts payable, function at an insurance company. And so, where we're at right now is we can accept stables as collateral. We keep most of our assets on chain. Um, when it's required for us to top up collateral to the insurer, there's off-ramping that happens, but it's fully attested. And so the point of us is to prove to the world that we have the capital to meet our obligations. And that's important from a counterparty perspective, but also a regulatory perspective. They need to know that we're solvent. And so what we're doing is working with these oracles, Chainlink, et cetera, to effectively attest to what the account balances look like when we do post collateral to the insurance company. As the insurance company pays premiums, again, we're an insurance company for insurance companies. As they pay us premiums, those get reflected and attested to as well. Economics eventually get off-ramped, back on-ramped again out of these trusts, and the economics are distributed via the stables effectively, right? And so stables as collateral, off-ramped when needed. Any off-ramp collateral is attested, and effectively, as the economics are generated, it flows back to the stablecoin holder and depositor. So that's a general flow.
Wow, awesome. So seems super clear now, but if any of our viewers has still some questions left, please feel free to drop it in the comment section. Follow us on X. Also follow Karn and Ree on X. Maybe you'll have a chance to get the answers you don't get from this interview from the first hands. And yeah, be active, guys. And we're moving on to the next part of questions. So the next thing I have prepared for is the following. So Ree is a decentralized platform that performs KYC. What KYC solutions do you use to remain decentralized?
Yeah, so look, we're like others, right? We're not trying to innovate in KYC specifically. I know that there are a bunch of protocols that are focused on like proof of personhood and like verified identity. For the most part, we just use industry standard tools, right? Like SumSub, and we've tried others. And I do think that there's some level of innovation that should happen in this place. Like I know that others have floated the general idea of like if you KYC, you should only ever do it once on a platform, and that should live in your wallet and all. You now any future KYC platform that you need to interact with, it can just reference the NFT or some equivalent that indicates that you have been KYC'd on a trusted platform. We're not innovating there. Like part of being able to scale really quickly is like hyper focus, right? And so you got to do one thing really well, and I think what the thing that we're doing really well is like we're scaling, right? Like it's the proof is in the pudding, and like the focus has been on make sure that we interface with our clients and meet our client expectations in the way they're accustomed to. Insurance companies are traditional businesses, right? And what we don't want to do is off-put them with technology that's not necessarily entirely relevant to them yet. And so we focus on that. I think we've done a really good, exceptional job of that. And on the other end, kind of, it's like business in the front, party in the back. Like it's like you ultimately get these unique structures that get formed that transform collateral into compliant usable stuff that insurance companies can use. And we're much happier kind of just like focusing and iterating on that. But all of it to say, like, if you're gonna go and start a company, you typically don't want to open up multiple fronts in a war. And you don't want to overbuild. Just do the thing that makes you money or makes your customers happy and focus on that. And then eventually you kind of expand scope of what you do.
Wow, awesome. And since we might say that, at least in general, you actually know your customers, could you please provide us some image of your typical users? Are they retail or institutional? Probably I heard the answer already, but maybe I missed something.
Yeah, yeah. I mean, our customers explicitly are insurance companies, right? Like we sell reinsurance to insurance companies. And so again, all of them today are in the United States. That doesn't stop us from being an international reinsurer. There's no reason why we couldn't write insurance business in the EU, in Latin America, in continental Africa, India. Certainly, there's no reason outside of regulatory hurdles and just hard work that could not happen, right? On the capital side, it tends to be folks that are slightly more on the institutional side. And I think as we scale, what you're going to end up seeing is like greater decentralization there, right? You're going to see a greater proportion of retail starting to kind of take that over. But I also caveat that with most of DeFi still tends to be whale driven, right? And so like you see meaningful capital formation around a DeFi protocol, and eventually you see retail trickle in. Very, very few are retail first.
Okay, awesome. So I got everything right, and just to prove this. And yeah, since you mentioned regulations, and you're actually a person who is based in the US, and you are physically closer to all of this regulatory landscape. So the next question will be actually about it. So could you tell us what upcoming regulation do you look forward to most, and why actually?
Yeah, yeah. I mean, I alluded to this earlier too. The stablecoin legislation is going to be incredibly important, right? It at least sets out the rules of the game, and for my purposes, it validates the general thesis that stablecoins would pick up broad adoption and be usable instruments uh, in a fully collateralized form in all sorts of industries, including our own, right? And so, right, for all intents and purposes, we're 100% of the insurance and reinsurance market that exists on chain today. And it'll be really interesting to like work with regulators, both stateside and offshore, on getting closer to like a seamless, pure stablecoin denominated insurance market, right? Will it be this year or next year? I don't know. Will it eventually happen? I think it'll eventually happen, right? There are just too many efficiency gains and like and other things that remove quite a bit of fraud. From this particular business and all sorts of financial services businesses for this not to be how this market proceeds. So stablecoins, very plain vanilla answer, but it is the truth that it's the most important thing to us and I think to many DeFi protocols.
Yeah, absolutely. So our viewers might easily see how stable coins becoming hotter and hotter topic, because every discussion we have here at Synopsys comes up to stable coins in this or that way. And speaking about the trends you are following, so is there anything else besides regulation and stable coins? Maybe just from your personal perspective, what you might suggest to keep an eye on for our audience?
Yeah, so I also alluded to this earlier. Like I'm generally interested in like proof of personhood, verified identity. I think those are going to be important tools. I'm also very interested in uh and this is kind of like antithetical for me to say because I don't love crypto infrastructure projects, but any sort of infrastructure project that is intended to act as a substrate to um, this AI and LLM revolution. You're going to have AI agents that lie, cheat, and steal when they're trying to interact with one another. You're going to need some verifiable truth that underpins these interactions, whether it's monetary or informational. And so anyone who is working on projects that kind of meld these two things, so the agents will eventually be able to just kind of like work in a trustless way, I'm very interested in. And I think like EigenLayer with EigenCloud is probably the step, I think they tried a bunch of stuff and it's a step in the right direction. But there are a couple of folks that I think are making pretty good headway there, and it'll be exciting to see what they do. But this is like the convergence, the natural convergence between crypto and AI, and it's actually it's kind of astonishing that these two things kind of happen at the same time, right? Because they're necessary. Each is necessary for the other to survive at scale.
Yeah, awesome. So verifiable truth is what we actually need in every
Yeah.
sphere of life, even in the anonymous and decentralized world of Web3, but still it's essential. Yeah, thank you very much. And we came up to our traditional part with the last question. So this one might be open. Previously, we spoke about the trends to keep an eye on, a piece of advice on that. So just in general, what might be your advice for our viewers? This might be some portion of inspiration, some call to action, some financial or non-financial advice, whatever you find useful, please go ahead.
Yeah. Look, I have the benefit of living in San Francisco and kind of seeing things unfold in real time. It's kind of a little bit like living a half step in the future. It's pretty cool. Um, I still think people underestimate the extent to which we are at an inflection point, both in kind of like the reconfiguring of entire, financial infrastructure that supports the entire global economy, and also the information economy with the advent of use of AI and LLMs. It is going to get crazy and crazy to the point where like it's very, very hard for people to predict exactly what is going to emerge out of all of this. But I think if there's a singular message here is that people should be optimistic. I think quality of life is going to improve for tons of people. Productivity and accessibility as like a human being. You quite literally now have superpowers to be able to do all of these things that we weren't able to do before, and live at like one layer of abstraction deeper than we were previously. So if there's a time to be optimistic, it's now because the world's changing in an incredible way. And if that means you want to go build things, right? If that means you want to go chill on a beach, then maybe that's also this is also the time to do that. But yeah, optimism kind of leads the way here.
Awesome. So thank you so much. A really valuable advice and a very optimistic ending here. So that's it for today, Currency Royal, ladies and gentlemen. Thank you for joining.
Yeah, thanks for having me again.
And yeah, guys, thanks for watching us till the end. Stay tuned, be optimistic, thumbs up to see Karen in more episodes. See you soon. Bye bye, everyone.